our forecast, you remember back in October, we thought, okay, first cut in May. I think the market's getting there, and the FOMC signaling that's what they'd like to do. 3 cuts this year, 4 next year. That holds us to our, long end of the curve forecast where we've been. Where if we're at 6.75 to 7 today on a 30-year mortgage rate, we think we'll be at 6 by the end of the year, 5.5 next year.
My goodness. I love when you come out swinging like that, Mike. Can you make some sense of the contradictory data that's out there? I mean, because there's a lot of it, right? We've got consumer spending ebbing lower. You've got consumer savings much, much lower. You have credit card debt, all-time highs, yet we're being told inflation is still a problem.
So, the January CPI data, people are pointing to some technical issues why the seasonal adjustment may be off, and it's really, we're not getting as much signal as noise there. You look inside of that number, again, the one that's really a puzzle for us is it's still showing shelter costs going up 6% a year at a time when rents are dropping in many major markets across the country. So the lag between that sort of market data on asking rents and the rent included the BLS it's much longer than anybody had guessed. But I think the flip side of that is it could drop like a rock here sometime soon. That shelter component, that's 40% of core CPI, right? It's a smaller component of the PCE measure, which is really the favorite of the feds. But regardless, there's going to be a lot of downward pressure on inflation here, not too long coming from the shelter component. The rest of it, yeah, again, the job market's stronger than anybody had guessed, which is good news for a home buyer, right? Their income's higher than they would have thought, and more confident about their financial situation. But it is putting a little bit of upward pressure on services costs.
Mike, let's talk about production levels for 2024. Where do you have us ending up as an industry, and have you had to adjust?
Just adjusting around the edges. We're still thinking a little over $2 trillion in 2024. So that's up about 22% from the 1.6 trillion in 23. And really the best news, and I'd be curious if you're seeing the same thing, is almost every lender I talk to saying they are getting a lot of demand for pre-quals. Obviously, the deals aren't closing yet because inventory is still tight, but the demand is there, even with the hint of rates going a little bit lower. And then we put out a number just end of last week. Applications to buy a newly constructed home up 19% compared to last year. So that's obviously been the real sweet spot of the market is new construction.
Yeah, so do you expect that to continue when we come out of this malaise, that new construction is going to be all the rage, or do you think that'll come down to more historic levels? I mean, historically, new construction represents around 10% of the inventory on the market. It's been well above 30 for some time now.
Now, I think that's going to be the world we live in the next couple of years, just because we underbuilt for so long. And then we still have, again, the very favorable demographics coming from the millennial cohort. And that's going to support the demand for years. I think, next 5-6 years at least.
That $2 trillion projection you have, does that include refinances or is that strictly purchases?
That includes refinances. So, you'll see the headlines from our forecast of, refis up 50% in 2024. But remember, it was like a drop in the bucket last year. So this year will be 2 drops. But it really is not a lot of volume, but more than last year.
Mike, give us an idea of where we are inventory-wise and when it's going to return to some kind of normalization. And will it get back to 6 months, which I think is sort of the high water mark we're accustomed to?
Yeah. Again, on the new home side, builders are picking up the pace. Permits are strong, north of 1 million. We got 7+ months of new home supply. But that really is only about 1/6 of the total market. With existing side, we still got 3.5. The high frequency data you're seeing from folks like Redfin, others are saying week to week inventory is coming up, even above and beyond what you would expect in a typical seasonal pattern. So I think you have sellers that put off selling last year, put off selling the year before. They have to move, right? The house isn't working for them anymore. So I expect inventory is going to go up, but we're still going to be tight. So the way to look at our forecast to see that, we still see home prices going up, going up 3-4% per year the next couple of years.
So the headlines from this latest chat with you is you feel pretty confident, obviously subject to change, that by the end of the year we'll be around 6%, and next year we, in all likelihood, will be in the 5.5% range at some point.
That's where we are. Yes.
Mike Fratantoni, you've got a hard job, my friend. I mean, this has been such a challenging runway here over the last 36 months. Really appreciate you sticking to it and always giving us time here on NFM TV. Mike, thanks.
Thanks, Greg. Appreciate the opportunity.
All right, we'll catch up again in a few months. Thanks so much.